Hi friends, myself Subrata Mukherjee and you are watching my channel Dr. Subrata Mukherjee Distance Learning in Commerce. Today we are going to discuss another problem on insurance claim for loss of stock. This is lecture number 4 and you can find the other lectures in the playlist section of the channel. I would like to request all the viewers to subscribe my channel and to browse the playlist section of the channel where you can find lectures on accounts, costing, financial management and management accounting. I would like to request the students to write the question with the solution and try to understand the way I have done it here. A fire occurred in the premises of a company on the 27th April 2003. All the stock with the exception of rupees 18,000 was destroyed by fire. From the following figures, ascertain the loss suffered by the company. Stock on 1st January 2002, 27,000. Stock on 31st December 2002, 66,000. Purchase during 2002, 4,60,000. Sales during 2002, 6 lakh. Purchase during 2003 up to the date of fire, 2,30,000. Sales during 2003 up to the date of fire, 3,15,000. On 4th December 2002, also a fire broke out and the cost of stock destroyed was rupees 10,000. There was a practice in the company to value stock at cost less 10%. But all of a sudden, the company changed this practice and valued stock on 31st December 2002 at cost plus 10%. Early in 2003, they raised price by 5%. The amount of the policy was rupees 50,000 and claim was subject to an average clause. Here, first of all, we have to prepare the trading account for the previous year. So let me prepare the trading account for the previous year. So trading account for the year ended 31st December 2002. So it is given in the question that the stock on 1st January 2002 was 27,000 and this value was 10% below cost. So we have to value the stock at cost. So here I am writing to opening stock. So the value of stock given in your question is 27,000. Now this 27,000 is valued at 10% below cost. So what is the value of stock at cost? So you have to multiply it with 100 and divide it with 90. So you will get 30,000. Next, the amount of purchase during the year 2002. So this figure is given at rupees 4,60,000. The sales during the last year was 6 lakh. So here I am writing 6 lakh. Now just before the closing date of the year, that was 31st December 2002, a fire broke out on 4th December 2002 and the value of stock destroyed was 10,000. So you have to record this abnormal loss. This is basically abnormal loss and the reason for abnormal loss is the stock destroyed by fire. So here I have to write by abnormal loss, that is stock destroyed by fire, rupees 10,000. And the closing stock on 31st December 2002 was 66,000 as given in the question. But rupees 66,000 was valued at 10% above cost. So closing stock which was given at 66,000 and this value of 66,000 is 10% above cost. So what is the value of closing stock on 31st December 2002 at cost price? So this will be 60,000. Now the purpose of preparing the trading account for the previous year is to ascertain the gross profit rate. That is the rate of gross profit you have to calculate from the trading account of the previous year. So the gross profit here we calculated at rupees 1,80,000. So 6,70,000 is the total of debit and credit side, and the difference is 1,80,000 that represents the gross profit. Now what is the rate of gross profit for the previous year? So you have to, this is step 1. This is step 1, that is to ascertain the amount of gross profit. Step 2 is to determine the rate of gross profit. So rate of gross profit is 1,80,000 by 6 lakh into 100, that is 30%. Now next step is to calculate the trading account from the first day of the current year to the date of fire. So this is step 3. And the trading account that we are going to prepare is to be valued at 2002 price level. So here I am writing trading account for the period 1st January 2003 to the date of fire, which was 27th April 2003. And you have to prepare this trading account at 2002 price level. We have to record the closing stock of the previous year as opening stock of the current year. So this will be rupees 60,000, and this 60,000 is valued at cost. Now it is given in the question that the purchase from 1st January 2003 to the date of fire is rupees 2,30,000. So I can write here to purchase 2,30,000. And it is given in the question that the sales during 2003 up to the date of fire is 3,15,000, and there was an increase of price by 5%. So you have to value the sales at 2002 price level. So the price level at 2002, there was you can assume it at rupees 100, and the price, that is the sales price for the year 2003 is 105. So what is the sales price at 2002 price level? You need to calculate here in order to determine the gross profit for the current year. So you will get the value of sale at rupees 3 lakh. Now you have already calculated the rate of gross profit. Now you have to apply the gross profit rate here to determine the amount of gross profit for the current year. So this will be 30% into the sales for the current year, that is rupees 3 lakh. So you will get 90,000. And the balancing figure represents the amount of closing stock on the date of fire. So this is basically balancing figure, and you will get a total of 3,80,000 on the debit side, and 80,000 is the amount of closing stock on the date of fire. So step 3 we have computed here. Now you have to determine what is the amount of claim, that rather the gross claim and the net claim. So what is the amount of claim? So this is step 4. So estimated stock on 27th April 2003 was rupees 80,000. You have to deduct the amount of salvage, that is 18,000. So your gross claim is 62,000. And this gross claim is subject to average clause. Now you have to determine what is the net claim, and this is step 5. So your net claim is equal to policy value, that is rupees 50,000. You have taken a policy for rupees 50,000 divided by value of stock on the date of fire. Multiply it with the gross claim, that is 62,000. So your net claim will be 50,000, that is the policy value, divided with the value of stock on the date of fire. You have already calculated, that is 80,000, and you need to multiply it with 62,000, that is the amount of gross claim. So your net claim will be rupees 38,750. This is your answer. So you can see that the total problem has been solved in 5 steps. So step 1, you need to prepare the trading account for the previous year in order to determine the rate of gross profit that you have calculated in step 2 at 30%. In step 3, we have prepared the trading account for the current year till the date of fire in order to determine what was the closing stock on the date of fire. And please remember that the trading account for the current year, you need to prepare it at the previous year price level, because you need to apply the rate of gross profit here in the current year, and the rate of gross profit remains or can be taken at the rate of the previous year, that is 30%. If there is a change in the price level, then the gross profit rate cannot be applied here. So in order to use this gross profit rate and the estimated stock at the previous price level, you need to prepare the trading account for the current year till the date of fire at the 2002 price level, that is previous year's price level. Now in step number 4, you need to determine what is the amount of gross claim, that is the closing stock minus the salvage value, and step 5, you have to calculate the net claim, that is the policy value divided with the value of stock on the date of fire and multiply it with the gross claim. And it is calculated at 38,750. Hope all of you have understood the process, the way I have done it here, and all of you have recorded the question with the solution in your notebook. If you find any difficulty, feel free to contact me through email and the number given in the description box. Thank you. Thanks for watching the lecture.